Good evening, everyone. Welcome to our webinar on taxes and retirement, where we're going to discuss the highlights of the Tax Cuts and Job Act of 2017, as well as the Secure Act of 2019 and the CARES Act of 2020. My name is Tom Kozlowski. I'm a certified financial planner, and with me is my partner, Andy Wilson.
Hi, everyone.
Andy's coming to us from his home office in Glenwood, Maryland, and I'm at our home office here in Newmarket, Maryland. Really excited that you're able to join us tonight because a number of these provisions that we're going to highlight are some of the best tax savings ideas, and we're able to use a number of these ideas with strategies to really save a lot of money. And I think you're going to see in some of these instances where we're going to show you some case studies where you actually may be able to reduce or totally eliminate federal income tax. So a few disclosures. So first off, Lighthouse Financial Advisors, that's our company, Lighthouse Wealth Management. We're made up of two separate companies. One is Lighthouse Financial Advisors, which is a registered investment advisor. We're a fiduciary. And that's where we do financial advising and wealth management for our clients. The other part is kind of where we're coming to you tonight, which is Lighthouse Tax Services, which we had created about 12 years ago to be able to provide tax planning, tax prep, and the implementation of tax strategies exclusively for our financial advisory clients. Now, as we go into tonight's, and we talk about different tax strategies, the one thing we want to kind of relay to you is that while a lot of these strategies sound really good, everybody's situation is a little bit different. And you need to find out, consult either with your financial advisor, your CPA, your accountant to make sure that these strategies that we're talking about are appropriate for you. Now, we're also going to be offering a complimentary consultation, which will tell you how you can sign up for that, so that you can ask us some specific questions or we can get to know you a little bit better to be able to answer some of those things that may be pertaining to you. Now, you'll notice in the chat box over here, we have a couple of handouts that we have there for you tonight. The first one, you'll see it says 2020 annual limits, kind of looks like this. And what this is kind of a handy dandy cheat sheet that we use around the office. It has like tax brackets, how much you can put into retirement accounts. It's a great quick reference if you want to take a look and see some quick questions that you may have on income taxes. We also have, you'll see where it says who we are in the chat box, and that's going to give you a little background on Andy and myself. And then finally, I mentioned to you that we're going to offer a complimentary consultation, and you'll see that we have, it says Tom's Calendly and Andy's Calendly. And those are basically our calendars where if you decide you'd like to talk to us, Zoom with us, or meet us in person, that's where you can kind of sign up for an appointment. Now, we are part of the Society of Financial Awareness, and that's kind of where we're coming to you at tonight again. Society of Financial Awareness is a group of financial professionals from around the country, CPAs, attorneys, financial planners like ourselves, who use that platform to be able to educate the community. We've been doing this taxes and retirement workshop here for the last couple of years locally, and we've had a lot of great feedback from it because, especially over the last several months now that we've started doing some of these, all the changes that have come about can really give you some opportunities to take advantage of. Now, the handouts again are in the chat room. So one of the things we want to do, taxes can kind of be a little bit of a boring subject. So what we wanted to do is to be able to give you an opportunity to win one of our coveted Lighthouse blankets. So how you're going to do that is in the chat room, we're going to ask you to go ahead, and the first person that can kind of accurately describe what this next picture is to us will win this blanket. So go ahead and take a look. Put your best guess there, even if you're not 100% sure. Put whatever you think it could be. Okay, we have a puzzle. That is correct. Anything specific about the puzzle? It's large. Yes. Okay. That's I guess that's as close as we're going to get this evening. So Cindy, you win the blanket here. So it's actually the world's largest puzzle. So it's about 28 feet long. It's about 6.5 feet tall. Again, I'm not sure where you're going to put it together at. You have to rent a gym, or you can see here in a business hallway, someone looks like they've put this together. And you can actually buy it on Google.
Amazon.
On Amazon, but it's about $440. And we actually have when I Google that, what the largest puzzle was, we actually kind of dispute that. And what we'd like to say is that this is actually the world's largest puzzle, which is the US Federal Tax Code. So you'll see that this one here goes all the way back to 2014. Now, there's been obviously a bunch of updates, and this actually is a little bit more than the actual tax code, because what this includes, this also includes your letter rulings, court rulings, and interpretations of the federal tax code. And again, this is showing you about 6 years old, and there's been a ton of changes. And the reason that we're showing you this, and we use the puzzles as an example, is because this is just the taxes are just a piece of everybody's overall financial picture, their overall financial puzzle. Because what happens with taxes certainly integrates with investments, with your estate planning, and it's all combined. And one of the things that we do at Lighthouse here is when we created our tax service, we also have an attorney, an estate attorney on staff. So what we do is we coordinate with clients to make sure that we're looking at all those areas of your financial puzzle to be able to maximize your financial potential and, of course, minimize any taxes that you may have. So tonight, our goals are, again, we could be here for weeks going through all of the, provisions, of course, and all these various acts. But I want to highlight some of the ones that we think that you can use yourselves to reduce your taxes. The other area that we're going to show you some case studies where some actual clients that we have that we've been able to reduce their taxes or show you the effects on retirement income streams. And again, there's going to be some tidbits and strategies that you can use yourself to reduce your taxes. Andy, over to you.
Thanks, Tom. A couple of things, just some people's chats were disabled. We apologize for that. We'll see if we can get someone to make sure that gets fixed. And sorry you weren't able to win the blanket, but we'll try and get that fixed for you. So the first thing we're going to talk about, I'm going to go over some basics real quick in the next couple slides. And marginal tax rates, just that tax bracket your last dollar falls into. When we do taxes and people come to us, they'll say, hey, I'm in the 22% bracket or the 24% bracket. And that doesn't mean that all of your money is being taxed at 22%, because we have a progressive tax situation in our system. So, that $0 to $19,750, that amount you're going to pay 10% on. So $1,975 in taxes if you make $19,750. And then when you go to the next bracket, which is, $19,750 to $80,000 and change, you're paying 12%. Once you get over 80,000, now you're in a 22% bracket. So again, you can see how that is a progressive situation. And a lot of people that might be in the middle of the 22% bracket are really effectively only paying a 14% tax overall on their federal taxes. When we talk about these things tonight, you'll see the MFJ, Married Filing Jointly. Actually, the document, the handout that we're giving out will show you single head of household. So again, in these examples, we're just going to use married filing jointly as we go through things.
The handout will have will show you what it would be if you were filing individual or as head of household and so forth.
Right. And the largest tax bracket you saw there was 37%. So again, another way to look at this, we use this heat map. And again, you know, you look at between 10 and 12%, there's not really a lot of movement there, but you look at that next bracket from 12 to 22 or from 24 to 32, that's where with a lot of clients, we end up saving them money at these brackets. And Tom, again, as I mentioned, is going to go through a couple examples at the end, kind of showing you how that works. So one of the things that changed in the new tax act was the capital gains brackets. Okay, so before they weren't set up in this structure. So now what ends up happening for capital gains is if you're married filing jointly, from $0 to $80,000, if an income, and you, let's say you have 50,000 in income and 20,000 in capital gains, you literally will pay 0 taxes on the capital gains portion. Okay, that was not the case in the past. So this is a great savings in this situation. And then again, between 80,000 and 496,000 in income, if any of that is capital gains, it's only going to be taxed at 15% as opposed to being at an income bracket, which could be 22, 24, you know, a lot higher. So it's a great savings. And again, you can see over 496, you're at 20% for the capital gains. Dividends. So when you look at dividends, this has changed too. And again, the incentive, if you look at capital gains, similar, dividends the same way. The incentive was put in place for people to invest into the market, okay? And let me explain why. So when you look at qualified dividends, this would be like stock dividends. I own T. Rowe Price stock. It pays a 3% dividend, or mutual fund dividends as an example. I'm invested in the market and they pay dividends. Now what ends up happening is those are called qualified dividends, and I pay a capital gains rate on those, which again is typically cheaper than if I were to pay at an income tax rate. So, which is very helpful in that situation. When you go to the non-qualified side, you know, you look at REITs or master limited partnerships, but more importantly, skip to the bottom, you're looking at your savings accounts, your money market accounts, or bond accounts. You know, in a bond account, mutual fund account, as an example, now you are paying, you know, basically ordinary income tax rates, because those are called non-qualified dividends. So essentially, you know, that's how those are structured differently now. And you can see where the incentive is to be in the market as opposed to being in bonds. Or in some cases, what we start to look at is, should you be invested differently, where, you know, for IRAs, maybe we're putting, if we want some money in bonds, we do that in your IRA. So you're not paying that income tax rate. Whereas for your stocks, you might be better outside of a retirement account. So this is a big one that changed for a lot of people, especially your first tax return in 2018 or 2000. Yeah, it would have been 2018, right, Tom?
Yep.
Yeah. So 2018 is when that changed. A lot of people probably did not itemize anymore. The standard deduction happened for a lot of people. And let's talk about that. So, you know, again, the deductions, any amount deducted from your taxable income. So the standard deduction got pushed up quite a bit compared to what it used to be. So for in 2020, for a married couple, you're talking $24,800, and for a single, $12,400. And we're seeing about 90% of our clients now, from a tax return standpoint, are using the standard deduction, and that's pretty true throughout. If you look at the itemized deduction portion, this is where you got to get over, again, if you're married filing jointly, you got to get over this $24,800 number. Well, you need enough mortgage interest to get over that number. And typically, again, state and local property tax up to $10,000. So these are the SALT provisions that got basically capped at $10,000. So if you're paying state taxes and you make, you know, $100,000 and you're in Maryland, and that's $7,650 plus you have, you know, $10,000 worth of property taxes. Well, instead of you being able to deduct 17,000 and change, now it's capped at 10,000. So that's why you can see where it's harder to get above that standard deduction. For people that had their house already paid off, the standard deduction became a huge benefit and probably reduced their taxes quite a bit. So it's been a big benefit for a lot of people. There actually is an additional deduction if you're over 65. So your standard deduction gets even higher. And also for people that are blind, there's a benefit as well there. So let's talk about the real tax system. We're going to talk a little bit about Social Security benefits and how those factor in for retirees, Medicare premiums, and we're going to talk about the Secure Act of 2019. So the big one on Social Security is basically the question that was always asked, is Social Security taxed, okay? And a lot of people thought, hey, I don't have to pay Social taxes on my Social Security when I receive it. And that used to be the case, and now it's not. You have this term provisional income. So in order to figure out if you pay taxes on your Social Security, you need to calculate this number. So we're going to use this example of somebody having basically $20,000 that they're getting from their Social Security. So if they have $20,000 that they're getting from Social Security a year, you take 50% of that number. So that's $10,000, okay? If you have any ordinary income, let's say you work part-time, you take money out of your IRAs, and that's another $20,000. So that's $30,000 together. And between dividends and capital gains of your investments, that's another $10,000. So now you have $40,000 altogether. Non-taxable interest, that's for people that have large amounts of municipal bond funds. That non-taxable interest actually gets calculated in here. We're just going to assume that's zero for now. So based on all that, you got basically $40,000 of income. You're married filing jointly, and let's go to the next slide and we'll see if you owe taxes. Well, if you were single, basically because you're over $34,000, okay, 85% of your Social Security, so 85% of the 20 that you're receiving, now gets calculated into your income for tax purposes, okay? Whereas if you're a couple, you're basically over the 32,000, but less than the 44. So up to 50% of your Social Security, again, of the 20,000 gets calculated into your Social Security, into your taxes. So you're not paying at these rates. They're just calculated in how much Social Security gets added onto your income for the calculation purposes. So, and this is, again, Tom will show you some examples where this comes into play for a number of our clients, when we're doing their taxes. I'm going to let Tom take this from here and kind of talk about, receiving your Social Security benefit.
Great, thanks, Andy. I misspoke a little bit earlier, folks. So if you want to ask us some questions, there is a Q&A section. Please go ahead and do that. We'll try to answer some questions now if we can. If they're more specific, that's what we would leave for, for a one-on-one consultation with you. So please go ahead and do that if you'd like. And also you should be able to see the handouts as well as our calendars now that are in the chat room. Okay, so one of the biggest questions that we get all the time is, when should I take Social Security? Should I take it early at 62? Should I wait till my full retirement age? Shall I wait till 70? And of course, there's a number of factors that go into it. So when a client asks us, the first thing that we typically do is we will run what we call a break-even analysis to see what is the break-even on being able to do that by starting early or waiting to a later age. So what I did here is I actually took my Social Security benefits. You're actually able to go on and get your benefits, your exact benefits, by going to www.ssa.gov, answering some questions, and you'll be able to look at your own account, and they'll give you projections on what your benefits would be. So for me, if I retired at age 62, this is showing you that it's about $1,929 per month. At age 67, if I wait, it'd be $2,772. And at age 70, it'd be $3,444. So how the break-even analysis works is we say, okay, let's say I start taking money at 62, and here's the $23,000. After 2 years, I've got $46,000. After 3 years, $69,000. And by the time I get to 67, I will have gotten $115,000, okay? So the next year, at 67, if I get another 23,000, I would have 138. But of course, if I waited, instead of getting 23,000 a year, I'd be getting $33,000 a year. So what happens is if we add up the balance in each of these columns here of what I would get at age 62 and what I would get at age 67, whoops, go back to this, what I would get at age 67, this shows a break even here. You'll see at age 78, I would have received a total of $393,000, whereas if I waited until I was 67, I'd get $399,000. So it's right between 77 and 78. So one of the funny things we always ask, if people say, when should I take Social Security? We say, well, tell us when you're going to die. We'll tell you when to take Social Security, of course. But reality, there's a lot of other factors that go into it. For instance, if you were going to continue to work at age 62, between 62 and your full retirement age, and again, for me, that's 67, then I'm only allowed to make $18,420 per year without being penalized. If I make more than that, I'm going to have to give back some of that Social Security. So as an example, if I was going to make $28,000, I'd be $10,000 over that maximum amount. So the penalty for that is actually 50%. So the next year I would have to give back, it's $1 for every $2 over that. So I have to give back $5,000. So that's another factor that we're going to look at if determining or helping our clients determine when to take Social Security. Okay. Now, other factors, as you know, do you have a lot of longevity in your family? What would happen if you really wanted to retire at 62 and needed income? You really needed that $23,000. Well, you might have to take that money out of your retirement accounts or the bank or what have you to be able to do that. So by taking Social Security early, in one instance, you are actually able to not have to take money out of your retirement accounts. One other factor I'd like to point out to people is that if you were to pass away before you got to full retirement age. So for instance, if I started taking Social Security at 62 and I passed away at 66, my spouse I would have received, which would obviously be available for my spouse, the $115,000. But if I passed away at 66 and did not start taking Social Security, then all my spouse would get is a death benefit of $250. So there is a lot of different scenarios that you have to look at when you're determining when to take Social Security.
And another thing real quick is, especially with couples, for us, it's very easy for us when we look at these numbers and do financial plans. We split a lot of couples. So certain couple might take, the spouse may take their Social Security at 62, but we make the other spouse wait till a later age in that situation. There's benefits for that because, again, if somebody takes it at 70 and one takes it at 62, and we'll use the example of the husband taking it at 70 and passing away first, well, that Social Security amount is going to be a lot higher. Well, when he passes away, the wife can then step up to his Social Security amount, which you can see in Tom's example is much higher than what it would be at 62. So it's almost like an insurance policy. So, you don't have to take it the same year. So there's a lot of planning that goes into making this decision.
And there's a lot of different combinations. So at one point, before they changed the rules a few years ago, and you might have seen when you signed up for this webinar, you saw it was called Taxes and Retirement 567. At one point, there were 567 combinations of retirement claiming strategies. Now that's been reduced quite a bit, but there's still a lot of other strategies that we haven't even talked about tonight that you want to take into consideration before deciding when to actually turn the Social Security on. Okay, one other area that trips up a lot of people here as well is Medicare premiums. So as you know, if you're on Medicare at age 65, you're going to have to start paying the basic amount, which is $144.60 per month. And this is per person, okay? But what a lot of people don't know is that this amount that you pay actually is based on your income. So as an example, you see here less than $174,000 is $144.60. But if you actually go $1 over, just $1 over, then it jumps to $202, and this is per month. That's almost $60 a month more. So, you're talking about $720, about $1,400 per couple. And you can see it goes all the way up. So if you have, some high earning years before you retire, you can see that you could be paying, several, over twice or three times as much as what you normally would pay if your income was lower. And what happens is this income is based on your 2 years before tax returns. So as an example, this year's premiums, 2020, are based on the income you made in 2018. And why is that? Well, the IRS does not have, or Medicare does not have, what your tax returns were for 2019. So they're going to base it on the one that they do have, which would be 2018's. So 2021 premiums are based on 2019 premiums and taxes and so forth. So, one of the things we try to do is when we have clients who we know are going to retire, let's say they're going to retire, here in 2020, or let's say they're going to retire 2 years from now. Well, we want to take a look and see where their taxable income is going to be to see if there's any strategies that we can do to keep them in the lowest bracket. Sometimes they may have a bonus that they could get. They may be able to have their employer pay them in the following year versus take it that year. So there's a number of strategies that you want to look at, but if you don't know about this, then you could easily get caught. Especially some people, when they retire, they may have some stock options they're exercising or other type of windfalls that they come in. It's just not the income tax that they pay or the capital gains tax they may pay. This is kind of a hidden tax that a lot of people aren't aware of that you should be, to be able to try to stay in lower brackets.
And when we're talking retirement, we're really talking about people within that age of around 63, right? Because you're 2 years away from 65. That's when we have to start paying attention to the income that you're making, because that's when it affects, these different premiums.
Yep, 63 or older, correct.
Yep.
Andy?
So I'm going to jump into the Secure Act of 2019. So the big thing, there was two big things, but I'm going to talk about the first one. It's required minimum distributions, okay? And that's changed. So if we go to the next slide and you look at required minimum distributions, essentially how they work is there's a table. And at 72, it used to be 70 and a half. Now they've gotten pushed to 72. You get to wait to that age now. You take 25.6, and if we'll go to the next slide, we'll look at somebody that's got $500,000. So December 31st of the previous year, they look at your balance. Let's say it's $500,000. They divide that by 25.6 because now you're 72 that year. You're required to take out a minimum distribution. It's about 3.8%, and that's about $19,531, okay? Each year, what you'll find is that divisor is going to get basically lower, which makes the percentage higher. And you're going to be required to take out a little bit more money every year as far as your required minimum distribution.
And what we're talking about as far as the 500,000, these are all of your retirement accounts, okay? Correct. So these are like, you would take the balance of your 401ks, your IRAs, 403bs, or if you're a government worker, a TSP. And then if the total balance was $500,000, again, the first year at age 72, the figure would be $19,531. One other thing to point out on this is, if this was all IRAs, you could actually take your money out of any of the IRAs. So if you had 5 different IRAs, it wouldn't matter. You could take $19,531 out of one of them, and that would satisfy. However, let's just say that you had $250,000 in an IRA and $250,000 in a 401k. You would then have to take it out, in that case, 50% each, half of it from the 401k, half of it from the IRA. If you do not, Uncle Sam decides to penalize you 50% on that figure. So if you had a 50% penalty because you didn't take out the other, in this case, roughly $9,500, you'd pay $4,750 fine, and you still have to take that other $9,500 out. So that's one that you don't want to miss.
It's one thing that we focus on quite a bit in our office with the spreadsheets that we have and everything else to make sure that we don't miss that situation for clients. So again, one of the other things, basically, you know, for inherited IRAs, one of the big issues that happened here in this Secure Act is inherited IRAs changed dramatically, okay? So before, what used to happen is I got my $500,000. If I passed away and it went to my spouse, same thing, no big deal. My wife jumps into my shoes and she has the $500,000, not a problem. But what happens if it goes to a non-spouse? Well, before it used to go into an inherited IRA. It still does. But before, you used to be able to take it over your life expectancy. So if you're getting in your 60s or 70s and all of a sudden you got kids in their 40s or 50s or their higher earning years income situation, they used to be able to get that $500,000 and over the next 30, 40 years, spread out the required minimum distributions and live off that money and keep it in the IRA and just only pay taxes on what they took out. Now what the government's done is they've said, you have a 10-year window, okay? Now that creates a tax implication, because if you're in a traditional IRA, which means all of it's taxable and you got $500,000, you know, you can let it sit there for 10 years and grow up to say $1 million. But then once you take it out by year 10, you're paying taxes on the entire $1 million. Or you take it out as you need to take it out, or by $50,000 a year as the example, but that's getting added on top of your kids' income. And they're going to probably pay a lot more taxes on this as they receive it. So for us, it's creating much more of a planning issue as before, because not nearly as much money needed to come out for required minimum distributions for that $500,000. Now being squeezed in 10 years, it's just a tougher situation for sure. So some exemptions to the 10-year rule. I mentioned a surviving spouse. They don't have that issue. Minor children. So each state has basically an age of majority. So either 18 or 21. So if you had a 10-year-old basically receiving this money, it went into a trust. At 18, their clock would begin for the 10-year rule. Those first 8 years would not count. If you're disabled or chronically ill, think about Social Security disability in this situation. You would not fall under this requirement. And then beneficiaries not more than 10 years younger than the original IRA owner. Think about a brother or sister, or maybe a live-in spouse that you're not truly married to legally, but you leave money to that's within 10 years. They just follow their regular required minimum distributions. They don't have the 10-year rule as it relates to that. Okay, additional changes. So, you know, one good thing is before you weren't able to contribute money to an IRA when you hit 70 and a half, once you got to that level. Now you still can, if you're making income, you have earned income, you can contribute to an IRA over that age, which is a nice benefit for certain people that want to continue to save. You also have this option of a penalty-free withdrawal, $5,000 for retirement plans. So that'd be IRAs, 401ks, 403bs for birth or adoption. So think about your kids, maybe where, you know, they're younger, they don't have enough money, something popped up and they each can get $5,000 out of their account and they need that 10 grand because of medical expenses, whatever it might be. So that's a benefit they put in there. And then also on 529 plans, the other benefit they put is for student loans, where you could take up to $10,000 and pay down your student loan, whether it was for your child or their sibling in that situation. All right. So let's talk about the CARES Act. So that obviously just got signed in on March 27th, and with everything going on with COVID-19, you know, there was a number of things that got put into place which could benefit people to kind of get through this entire process. The biggest one for us was the elimination of required minimum distributions for this year. So if you are taking required minimum distributions, you can literally stop and you don't have to take out for the rest of the year. We anticipate in 2021 that will start back up again, where required minimum distributions will be, you know, need to be taken. But for this year, you can eliminate that. There's a lot of people who don't want to take money out of their retirement accounts, would rather just let it continue to grow, especially with the way the market's behaved. So it's a big benefit. Filing date, move to July 15th. That's for filing your federal taxes as well as paying your estimated taxes. Normally you would pay estimated taxes for the first one in April 15th, your second one in June 15th. Both of them have been moved to July 15th. So for people that pay quarterly taxes, that's been a benefit from that standpoint. There's also been for people that use the standard deduction, when you do a standard deduction, you don't get the benefit of using or getting a charitable deduction in that situation. So in this case, you get a $300 charitable deduction on top of your standard deduction for this year if you wanted to give money as well. Going back to the RMDs for a second real quick, and that's something we talk about a number of times for our clients. If you do get a standard deduction and do not itemize, one of the benefits of using your RMD is you can actually choose charities to basically give money to and have it paid through your required minimum distribution. So if your IRA is taxable, this is a great way to make it non-taxable. So instead of going into your bank and grabbing money out of your pocket and basically giving it to your charity, and I'll use church as a good example, right? 52 weeks, 52 checks a year, putting in the basket. Instead, a lot of people, what they're doing is twice a year now, they just write a check for that 6-month period. And now they're taking it from their required minimum distribution, their IRA, and basically using that money. It's not taxable to the charity. It's then taken off your income and not taxable to you. So there's a true benefit to that. And essentially what ends up happening is you just have to fill out a piece of paper. We hold most of our accounts at Charles Schwab as an example, and Schwab will process that for you and get it to your charity or get it to you so you can get it to the charity. So just another example of an opportunity that we use for clients. All right, some other things that were really interesting. Obviously, when all this stuff happened and the market went down as much as it did, and we got 40 million people unemployed, they allowed people to take $100,000 withdrawal from the retirement accounts without paying the 10% penalty. So, and what it allows them to do is pay the taxes over a 3-year period. So I take $100,000 out of my 401k, and now instead of having to pay taxes on the entire $100,000 this year, I get to break it up 33 and a third, 33 and a third, 33 and a third. Okay. If I want, things in the next 2 years or the third year come back and things are much better, I can actually pay my $100,000 back in the account. Okay. And then I will get a credit or essentially have to refile to get my money back for the taxes I paid in year 1 or year 2 in that example. So there's some planning opportunities for certain people that may have lost their job or ran into that problem. Also, in the past or this past year and before, you were always allowed to borrow up to $50,000 out of your 401k, 403b, TSP. Now it's $100,000. So they increased that. And again, you basically pay that back to yourself. It's a fairly low interest rate that you pay yourself. And there's usually a little bit of a cost to set up a loan through your program, but it's they increased that number to allow people that benefit.
They also, as part of that, used to be you could borrow 50% of your vested account balance
Up to 50 grand.
$50,000. Now, for instance, if you had $40,000 in there, you could actually borrow all $40,000 if you needed to. You don't have to. It's not 50% anymore. It's actually 100%. So that's another good place to, if you need to, if you're in dire straits and need to access money, that's another place. Okay, this is where we get to some of the fun stuff. And I say fun stuff because this is like an example of people who come to us and where we get to help them with their puzzle. We get to help them figure out how they can actually try to say, what are the best places to generate their income from. So we've got Brett and Brenda McFrugal. and they're married filing jointly, 67 years old, and they say, Tom, I need $100,000 of income. And so then I ask them, I say, well, where is your current income coming from? And they say, well, between us, we're getting $50,000 in Social Security. We typically get about $5,000 a year in capital gains. We have about $5,000 a year in qualified dividends. So we have a shortfall of $40,000. So then we say, okay, I ask, what are your assets? And again, combined, they have about $1 million in their IRA. They have $150,000 in a Roth IRA. And they have about $350,000 in what's called a non-qualified accounts. So these include things like just money in the bank, savings bank, CDs, if they have a brokerage account, stocks, bonds, and so forth. So this is where we're going to do a little poll and see what your thoughts are. So if you wanted if the McFrugals wanted to pay no income tax or little income tax, where should they withdraw the money from? So if you'll pick the IRA, the Roth, or non-qualified account, go ahead and check that. And I just want to get a pulse here of where everybody's at, what they think the answer would be here.
So Amanda, Tom, can you see the poll? Oh, there it is.
Ah, now we got it. Okay.
There it goes.
So we have 23% said the non-qualified account, 38% said the Roth, and 38% the IRA account. Okay. So it's kind of a combination. It's a trick question, but actually the first 15,000 should be withdrawn from their IRA accounts because it would actually be federally tax-free. And the reason is and normally when we do this workshop in a seminar setting, we actually have our software there where we can kind of go through and show you a little bit more how it works. But basically what happens, if you remember when we were talking before, that Social Security is taxed based on your provisional income. And again, that was a formula. And then what happens is by taking that, Social Security, when you take your other income and add it to it, there's some money that you can get out of your retirement account, in this case, the IRA, without triggering any tax on your Social Security. And even if and with having at least $24,800 in the standard deduction, this put the McFrugals at a point where literally they could take $15,000 out of their taxable IRA and pay no federal income tax. Okay. So, for those of you who do, taxes on your own, if you're working with Quicken or any of those, I don't know if they have that type of I don't think they do that optionality to do that. And that's one of the things that we do for our clients. And it changes each year, right? Because if our clients have different income from different sources in different years, you want to find out what is the most tax advantage place to take that money from to keep your taxes reduced. Okay, going to give you one more case study here. I got a lot of money and I need a lot of money. So again, married filing jointly, they're 66 years old. Very similar, they have $100,000 of income need. Current income, Social Security is $60,000 between the two, and they have some qualified dividends of $10,000. So that makes them $30,000 short of having their $100,000. Again, assets, they have the $100,000 IRA, the $150 Roth IRA, and $350,000 in non-qualified assets. Okay. Now, in this case, and this is a actual situation of a client, this person has $350,000 of a stock, call it Microsoft stock. They've had it for years, and they have a $100,000 cost basis. And they really have not wanted to sell the stock, obviously, because that's going to generate a lot of capital gains. So we're going back again to, the poll. And if this client wants to pay as little federal taxes or no federal taxes, I'm going to ask you again, where do you think they should draw their money from, the $30,000? Okay, so we have the IRA, 29%, the Roth IRA, 36%, and the non-qualified account, 36%. And the answer is the non-qualified account. And again, here's why. If you remember, when we looked at the capital gains tax brackets, between 0 and 80,000, there was 0 capital gains. They have $100,000 total income coming in, with part of it Social Security, and after even their standard deduction, that puts their taxable income at less than $80,000. So here's a situation where not only can they pay no tax, but it's allowing them to reduce how much they have in one stock. You know, there's a lot of people who work for companies where, again, they retire, they've had company stock for years, and they've had a significant amount of gains. And it's very difficult to let that stock go a lot of times when, you know, you've been with that company for a number of years, but you really don't want to have a significant portion, you know, 35% of your investments in one stock, no matter how good it is. You know, we've got a ton of examples of that, GE, you know, so on. So this not only gives them an opportunity to pay 0 federal taxes, but allows them to reduce their stock holdings as well. Okay, so to kind of wrap things up here, there was in the 1930s, Judge Learned Hand was a New York District Court judge that oversaw some famous tax cases. And one of the things that he had said, one of his famous quotes was, "Anyone may so arrange his affairs that his taxes shall be as low as possible. He's not bound to choose that pattern which will best pay the Treasury. There is not even a patriotic duty to increase one's taxes." So hopefully you've seen here tonight where, especially with a lot of the newest laws, the Secure Act and the CARES Act, there's a lot of opportunity for planning. And if you do it properly, you really can save some significant monies. So at this point, I want to highlight again that we were talking before that we're offering a complimentary consultation. So basically what you can do is, if you'd like to book an appointment, when we talk about appointment, it can certainly be a Zoom. We're doing a lot of Zoom meetings these days. If you want to call us, if you want to set up a in-person meeting, we are doing those following some you know, COVID-19 guidelines. But you can see our calendars again over in the chat room. You'll see Tom's Calendly and Andy's Calendly, and we'll have some times that we are available. We do have some evening times that are available for you as well. And so typically what's going to happen at this is, what we're going to do is we're going to ask you, you're going to ask your questions of us that you may have questions for, and we're going to dig a little bit deeper into your situation to see if there are areas that we can help you with, whether it's just saving money in taxes or overall financial planning ideas. And again, what you learn that's new typically is when we see your situation, there may be areas, and there usually are areas, where we can show you that you might not be thinking of that we didn't even cover here tonight, because we've only got about 45 minutes that we're doing this, and we certainly can't cover all of the potential tax savings areas. We're not trying to sell you anything. I think we mentioned to you before, we're fiduciaries. We don't have any investment products. We don't have any insurance products that we're selling. Basically, we are a fee-for-service company. I think I mentioned to you before that we have this program called Compass, where again, when a client does choose to work with us, we not only do their financial planning and investment advisory, but that's where our tax department comes in, and we do tax prep, we do tax planning, tax strategies, and we also have a estate planning attorney on staff that provides estate planning documents, wills, powers of attorney, and so forth. And that's all packaged together at no charge. So after you call us, if all you wanted was a couple questions answered, that's great, no problem. But for those of you who may want to engage further, basically what we're going to do is offer anybody here that if you do schedule with us by the 19th of June, then we will discount our fees. I mentioned to you, we don't do any commissions. It's all fee-based. And depending on your situation, what you need, we'll be able to give you the exact information when we were to talk to you.
We had a
now, one of the, I think one of the questions.
Yeah, let me jump in there, Tom. So we had a question about annuities.
Yeah.
Tom and I understand annuities very well, inside and out. There's still not a lot of annuity products being pushed out there that have quite a bit in commission. It's not something we're really do. It's not something that we think makes a lot of sense. It makes a lot of sense for the person that's selling it in most cases. But if you have annuities, we can still help you with all those kind of things. There are some older annuities that are actually still very good. A lot of the newer annuities, and it's just based on interest rates right now, it's hard for insurance companies to build a product that is truly beneficial to you because they water down the investments, they charge higher prices typically. So again, those are things we can discuss when we look at your accounts to decide if it makes sense for you to keep an annuity or, basically, it doesn't make sense and there's other opportunities that you could do with that money.
Great. We have one other question that went to the Medicare premiums, and the question was, is that premium the same every year? So for instance, if one year you pay the higher Medicare premium, that's only for that year. It's always based on your income 2 years before. So in the example where a married filing jointly was $174,001 and you paid $200 a month instead of the $144 in your premium, that's only for that year. They'll look at what your tax return was the following year to see what it would be for the following year. So you're not locked in once you have it. It really depends each year on what your income is.
And I'm just going to jump in one time. We talk so much through this stuff that sometimes when we're talking, Tom's mentioning about how the taxes are free, the estate planning's free. Essentially, we charge a percentage for the overall package, and that's what he meant. The whole thing isn't free, obviously. We're charging a percentage to manage your accounts, but for that, we'll do your taxes, we'll do your estate planning, and it's all included in that one price. And again, depending on where you are with assets and the help that you need, when you get a hold of us, we can kind of give you exactly what those numbers are. But we've compared against where we are in the industry, and we're pretty much in the middle.
Great. All right. Well, we have no more questions right now. So again, I want to thank everybody for attending, and good luck in your fight.
Stay healthy, stay safe.
Yep.
Thanks, everyone.
Thank you.